markets. There will come a time, I suspect, when you will see silver markets manipulated in the near term in the other direction.
Hey, so Rick, it's all over the news is JP Morgan's. There's this criminal trial going on for a bunch of their guys who refused to cop a plea. And, this one guy's testifying. This is the latest news that's on Zero Hedge right now is one of the guys who did plea for a lesser sentence is saying this was like an open strategy. It wasn't just a couple of rogue traders. This is something these guys were trained on by their bosses. What's your thinking here?
Jim, you and I have had this discussion on your show for at least 2 years.
Probably not, because we've only been on for a year and a half. So not
okay, year and a half. Then. Short-term manipulation of markets is a function of trading desks. All markets, I think, in the very near term are manipulated. LIBOR has been proven to be manipulated. Markets as large as the U.S. Treasury market and the Euro market have been manipulated. The technique which is described, spoofing, is a technique that is as old as published trading. I remember early in my career in the Vancouver Stock Exchange, it was very common for people to put very large bids slightly below market with a reputable brokerage house and then affect their selling in small pieces through lesser known brokerage houses, a different form of spoofing. What I would really love to see come out in the JP Morgan trial is not so much the near-term manipulation of the spot market or the near futures market, but rather a discussion of the probability that JP Morgan and or others might have used the spot market, the overnight market, the cash market to manipulate the long futures market. Mm-hmm. The circumstance where it is very common for the daily market, the futures market in silver to trade on a daily basis 100 times the silver available for good delivery around those contracts, and the extraordinary amount of nominal or notional value in the futures market means that a well-organized syndicate could structure shorts 6 months, 12 months, 24 months in advance in the futures market, highly leveraged contracts, of course, making the margin payments, and then borrow physical silver, which they sold in the overnight market during periods of time when there was very little liquidity in that market. The idea being in the very near term to drive the price of silver down extravagantly and take advantage of how that would impact the futures markets. Let's say, as an example, that somebody managed to be short $1 billion or $1.5 billion on margin in the out months. And then someone borrowed $50 million worth of silver to dump on the overnight market. Somebody might lose $45 million on the current trade, and they might make $100 million on the long trade, which is a lot of fun. And I suspect, given the way I've looked at precious metals markets for 30 years, given the fact that these very large trades occur during periods of time when there's no liquidity in the market, that's precisely what happens. Why would somebody who is trying to maximize their return on a silver position or a gold position sell a large position during a period in time in the market when it was certain that you couldn't get a good fill? There has to be some ulterior motive other than epic stupidity. And I don't think that's the reason. I don't think, as many of the conspiratorialists will say, that this suggests that JP Morgan or anybody else was engaged in some decades-long conspiracy to unlawfully depress the price of silver. Mm-hmm. I remember myself in the 1970s when I think it was fairly common for trading desks to manipulate the price of silver higher, which is to say, you take advantage of market conditions and you take advantage of illiquidity and you take advantage of investor stupidity in the way that's the easiest. And so far in this cycle, the down has been the easiest. There will come a time, I suspect, when you will see silver markets manipulated in the near term in the other direction.
God, I'm looking forward to that. Looking forward to that. So, the other thing going on in the world right now is we have these massive negative real rates, which should be really great for gold and silver gold prices in particular. And the one example is the European Central Bank just raised interest rates by 50 basis points, 0.5%, all the way up from negative to 0% now to fight inflation, which I find mind-boggling. They have 8-9% inflation in the Eurozone. They've raised rates to 0%.
Crazy.
It sounds preposterous to say it that way, but that's what's going on. So negative rates, I mean, this is negative real rates, right? And so, are you shocked that gold and silver still are not responding to this environment?
A little shocked, but I have to say, I again was around for the decade of the 70s. And beginning in 1968, it was very obvious, even to a then, 17-year-old, that inflation was on the horizon. And because investors and savers and speculators had lived through 20 fairly benign years prior to 1968, the market didn't notice inflation really till 1972, the politicians till 1974. Fast forward, we've lived now through 40 benign years from 1982 to present. For most people, inflation is becoming a concern, but it isn't affecting their lifestyle, at least most people who have enough money to invest and speculate. When someone goes to the pump and they're paying $5 a gallon or something like that, it's an inconvenience. In 2 or 3 years, when the purchasing power of their wages and their savings isn't enough for them to buy a new car.
Right.
In other words, when it goes from an annoyance to a lifestyle concern, then I think you'll see some action. And that's true too with the way people invest. People have lived through 40 benign years. They have come to believe that the Fed has their back, that the big thinkers of the world, be they Biden, be they Trump, be they Merkel, are going to kiss everything and make it better. I suspect those people are going to be disappointed in time. It's interesting that the popular media culture talked about the unexpectedly large increase in Eurozone interest rates and didn't point out, as you did, that they just got up to zero.
Yeah.
In other words, the direction merited news, but the quantum did not. It's really useful for your listeners to cut through the chatter and remember the famous Jim Grant quote about long-dated government securities in this pricing environment. He calls them return-free risk. If you think about the credit quality of the countries that are involved in issuing this debt and understand that you as the taxpayer are their collateral, if you look at debt to GDP or debt to obligation or debt serviceability, and you look at credit quality that's compromised, and then you look at the fact that your real economic return on the obligation is in the United States minus 5.5% compounded, or in Europe minus 8% compounded. This is a government guaranteed loss. This is actually the first time in my lifetime that I can remember government keeping a promise that I am certain that they will deliver on. They absolutely positively guarantee me as an American that if I buy a US 10-year treasury, that I will lose 5.5% of my purchasing power annually for 10 years.